bit of a complicated mess. So, how do we go about it? How do we navigate it? And, what are the mistakes that founders usually make? We've gone through this a couple times. We've raised money not only for our own company, but we've helped a bunch of founders navigate this process. This is literally what we do. So the most of the red flags that we find through the process are the ones that you can see here. So, going from wrong investors to pitching the wrong type of investor, to not running the right budget, obviously issues on the pitch deck, which we'll get to, and it's the core of what we're talking about today. Due diligence. And again, pitch deck is the first thing that we want to focus on. And I want to keep this session as interactive as possible. I don't want to just talk at you for 1 hour. So let's try a little trivia moment. Tell me, what do you guys think is wrong with this slide? I'll leave it there for a sec. What doesn't work with that slide? Drop it in the chat. Hi, people on YouTube. I see Milan Transmedia. What's up, guys? Yeah. So same for people on the Zoom webinar. You guys, the people on the YouTube link have a bit of a delay, but people on the webinar are live. So tell me, what doesn't work about that slide? Oh, sorry. There you go. Any takers? Random question. Okay, I see it. Okay, so Crystal says, too busy. Darshan says, the second should be a Sam and not a sum. Okay. I actually, which are right. It's top down versus bottom up, says Mandeep. Malan says too large and vague target market. I think Malan Scott is on the right track. So the problem with this slide mainly is that this is it's not a good time slide. And the reason why it's not a good time slide is because it's not giving us the answer to what we need to know on the pitch deck. The question that the TAM slide should be answering is, how big does the company get? Right? It's not so much about, like the SaaS market in the US is like $3 trillion. I mean, I'm sure it is, but that doesn't mean that you're going to be $1 trillion company. It also doesn't work if you say, like there's $1 trillion market, I'm gonna take 1% of it. That also doesn't work. So the ideal go-to-market, so the ideal TAM slide should be very specific about your capacity to grow to this market and to own this market, your TAM, right? Your total addressable market. So at the very core, a TAM slide should be a simple operation of how many customers are there out there for you and how much revenue do you make annually per customer. That's it, right? Again, those are hard numbers to find because you have to refine that. It's not everybody who owns a SaaS product. It's not every business user. It's not every person in the world. It's not every end user. You have to kind of peel some layers out of that audience. Maybe it's everyone within a certain age range. Definitely people who have a job, right? Unemployed people will never pay to you. It's people with certain purchasing power. It's people who are into tech. It's people who, and then that you start kind of narrowing that down to the real market that you're targeting. And again, to Jonathan's point, I see it on the webinar is, show your math. How do you get to this number? You've compressed and you found the ideal market in terms of users, and then you've really debugged or de-risked your pricing. You know that your pricing is right, that people are willing to pay this. So okay, it's safe to assume that if we can get to all of these people, that's the size of this business. And the idea with an ideal tech startup pitch deck should be targeting markets that are in the hundreds of millions of dollars, maybe in the billions of dollars. Okay, let's try another one. Just one more trivia on the slides. What is wrong with this other slide? Tell me. I'll give you guys a sec. All right, so I'm seeing Jonathan, timeline, costing, metrics. This is supposed to be a go-to-market slide. Who else wants to take it? What's wrong with this slide? What doesn't work as a go-to-market slide? I'll take one answer and then I'll give you the answer. No focus, doing everything. Generic from Uzoma, Crystal. Okay, on the right track, guys. Yeah, so the ideal go-to-market slide for a company should tell investors or should tell the reader of the deck what unique idea about acquiring customers they have that's going to allow them to beat the competition, right? So this is not telling me how this imaginary company is beating the competition, but this is a real slide. We actually stole this, changed the branding so you wouldn't know which company it was, but this is a real pitch deck that we got. You're trying to pitch this as, hey, like this is our go-to-market. And the problem with this is that, yeah, it's too generic. You're trying to do everything at the same time. I'm sure that a company should probably try all of these different channels at some point. But it's not what you put in a pitch deck, right? What you put in a pitch deck is, hey, like here's our growth strategy. Maybe it's one channel that's explained very well. Maybe it's two channels that are explained very well. Maybe it's it's a combination of other channels, but what we want to know is what's unique about that. Some of your unit economics, if it's working, how are you growing? Rather than just giving me this is literally just a list, a nicely designed list of marketing channels. That's what you should absolutely be avoiding. Let me see if I can fix the screen now. I think this should look better. Right. I'll check if the stream is working. I think it is working. Okay. So here's a question for you. And this is one to kind of throw in the chat, and we can talk a little bit about it, and we can focus the purpose and the stuff that we're going to talk about over the next few minutes around the answers to this question. So what are you struggling with on your pitch deck the most? I'm going to say story. So maybe it's a question of trying to compress all of your slides into 20 slides, summarizing, figuring out what should be included, how to make your story exciting. So if that's your case, just type out story in your chats, YouTube or Zoom. If you're struggling with a specific slide, maybe it's the TAM slide, maybe it's the go-to-market slide. We've gone through those, but maybe it's another slide. Maybe it's the problem or the financial slide. Type that as well. So just say slides. Or if it's with design, type that as well in the chat. So if it's maybe designing or looking for inspiration or ideas on how the pitch deck should look better, type that in. The reason I ask is I can talk about each one of these more in depth, or I can lean against one or the other. I want one specific slide. Dave, I see you on slides. Like, which specific slide are you focusing? Are you struggling with? If it's story, I can can be a little bit more broad about it. Competition, I see from Dave. Okay, we'll talk about that. Okay, feel free to drop your comments as you keep going. Storytelling, I see from Milan on YouTube. Great. Okay, so let's start at the. Waxy says all three, so that's fair. Okay, so let's start with the very basics. A pitch deck. What is a pitch deck? So a pitch deck is a story, a company story, a summary of what the company has accomplished, and a pitch and a vision of what the company is going to become. And if there's any slide that you want to steal from me, it's this one. So feel free to take a screenshot of this. Like this to me is the perfect pitch deck story arc. We have an article about this on our website. We'll paste the link. But essentially this, following this structure is what I believe is the ideal, the best 10 years. I've been doing this for 10 years. So, summarizing a story into these blocks is the best tool I can give you today. So again, if you want to steal a slide, it's this one. So, let me go through each one of these sections. Let me go back so we can see them. So we have intro, status quo, solution, market, why us, and ask. And I'm going to get into each one of these. And this provides a good framework for you guys to kind of distill your slides. So in the intro section, there's not a lot to talk about there yet. There's a cover slide. There's a traction teaser, which is a red flag. And I see a lot of, there are a fair share of online articles that'll tell you, hey, you should put your traction up front. And that's fair. They have a point. It's exciting to see a company's traction early on, but only if that traction is good. Only if that traction is something worth bragging about. And if that's the case, please put a traction teaser at the beginning. It shouldn't be an in-depth slide. It should be just a good overview of, hey, like here's what the company is doing. Here's what and here's how revenue has been growing over the past 3-4 months. Just to kind of tease people and say, oh, like we're actually doing really good. Keep reading, right? Keep reading to learn more is the idea. I hate executive summaries. I normally don't recommend including those because an executive summary just tries to summarize everything that the pitch deck is doing, but that's what the pitch deck is. Like it's literally a summary. So, I don't like when companies spend too much time trying to come up with an executive summary. It's a bit of a formality, and I think it's like those movie trailers that just spoil the entire movie. Why would you do that? Like just give it to me in the order that you created it. Okay, so let's go to status quo. So status quo is, to me, a section that should answer this specific question, which is, what opportunity have you discovered in the market? What are you doing? What's happening, what unique insight do you have about the status quo that maybe people have overlooked, that nobody's noticed, or that nobody else can solve? So this obviously ties to a market overview slide, which is optional. Gray here is optional, or to a problem or business opportunity slide, which is normally the core of every pitch deck, right? So like problem, what is the problem that you're solving? Companies are wasting X amount of time or X amount of dollars doing this problem, or people are wasting this amount of time doing this, or there's no real good solution to stream all of your movies in the same place, because there isn't, but that's a bigger problem to solve. So it's a problem. It's ideally should be a pain point that's really, really painful, that is really inconvenient, and that people, of course, would be willing to pay for. The bigger the pain, the more you can charge for this product, in essence, right? So now, important note here is that not all businesses are solving a problem, right? There are a handful of business types that don't solve problems. They rather just tackle business opportunities. For example, my first company was a mobile app, and a mobile app doesn't solve a problem. A mobile game, really. A mobile game doesn't solve a problem. It's just a mobile game. It's an entertainment thing. It's tackling on this business opportunity. This is back in 2011. So our problem slide, or a business opportunity slide, was, hey, like, here's this new thing that's called the iPhone. Very few people have one. Millions of people are going to adopt iPhones over the next few years, and we want to ride that wave. That was the business opportunity that we pitched, and that's valid. It's not a problem; it's an opportunity. Okay, next section. So the next section is the solution section, and what the solution section should answer, again, always think of a question, and whenever you're struggling writing the pitch deck, try and zoom out for a sec and go back to this question. What is the question that you were trying to answer on this slide, and answer it. So what have you built to tackle this problem? How does it work, and who is it for? The solution section should answer this question. So some of the slides to include here are the solution slide, the product slide, a demo slide, which I'm not a big fan of. I would consider that an optional, or even a don't include, because if you put a video there and that video lasts, I don't know, 5 minutes, just explaining your product, most investors are willing to spend about 4 minutes looking at a deck. So your video is longer than the time they plan to invest reading these slides. Video may require audio. It may require you to be in a quiet place. I mean, it's complicated. So I don't love demos or video demos. I like product screenshots. Definitely go with those. Can brag about the features in the product, but make it so that it's consumed without requiring a video, is what I'm trying to say. How does it work? Tech infrastructure, if there's something special about it, if there's something unique about your infrastructure. Target audience, a case study. I love case studies because they're a good way to show people, hey, like, this is my audience. This is the startup. This is the type of company that I'm looking for. This is my type of customer, and this is how it benefits them. This is how they became 50% more efficient after they adopted us. So it's a good way to sort of, in the package it as a little story, to tell people like what you do, who is it for, and what benefits does it have. So the case studies are really great, especially in B2B. Business model slide, it's has a red dot because a lot of people struggle with it. Business model slide is simple. It should be just a quick summary of just how you make money. If it's a subscription, okay, this is our subscription, great. If it's a platform as a service based on usage, okay, just explain what that is. You don't have to go into forecasts. You don't have to go into like, hey, we need X amount of customers to become profitable. That comes later. Business model is just within the solution section. We're talking about the product. Just how does this product charge its customers? Roadmap, I like. It's a good bridge to the next section. Think of the roadmap as a section as a slide that just tells us a little bit of what has happened, like the milestones that you made coming up to here, and especially the milestones that this round of funding is going to fund. I see people go all the way back to, hey, like, we incorporated here, hired our first team member here. Like, we don't need that level of detail. It's more about product milestones, right? About not even growth milestones, like literally product milestones. Remember, we're still in the solution section. So that's kind of what I'm going for there. Okay, next one. So the next slide I'd say is the sorry, the next section would be the go-to-market section or the market section. And the question that this section should answer is, whoop, there you go. How much are you growing, and how much are you going to continue to grow as a business? So some of the slides that are to be included here are the traction slide, the unit economics slide, go-to-market, which we talked about, potential outcomes. I like this slide, like the Uber pitch deck. We'll paste the link to that. The Uber pitch deck has a really nice potential outcome slide, which the fun thing about it is that the best case scenario that the Uber founders forecasted was that they'd get to like $1 billion valuation or something like that. Which I figured was pretty crazy because they completely overshot their own assumptions about growth. So I thought that's a good, nice, fun case of a go-to-market slide to study. But remember, let's go back to the original question for this slide, which is how much are you growing? How much are you going to continue to grow? How are you going to capture this huge market that you talked about? How are you going to solve this huge problem that so many people are experiencing? The slides normally to include here are, oh, sorry, my bad. Now, what are we doing to that? So next up, why us? So on the why us section should focus on, well, why are you and your team the team to change the status quo? What's special about you? What do you know? What do you understand about the market that other people don't, that other companies don't, and why you're going to beat them at it? So I saw a question, it was Dave on competition. So this is the context in which the competition slide fits. Again, it's more, you can use competition slides or competitor slides to, two ways. One, you could use it as a way to sort of prove that there is a real market opportunity here and that people are paying for this product, that this is a solution that exists, that other companies are already capitalizing on this business opportunity. So I've seen competitor slides that just give us a quick overview of maybe 3 or 4 biggest players in the market. Just as both as a sense of, hey, like we understand what these companies are, here they are, here's an example of them, almost as a market validation, if you will. But there's also, after that, the competitive advantages, which is a section or a slide that should talk about, well, here's what we're better. And the reason why you're better, it doesn't only need to be features. So it's not so much like a feature comparison table. It's more about, hey, what do we understand about the market that they don't? Or why are we just better at this? Are we better connected? Are we in a better location? Do we have a better product? Like what is it that makes us unique? That connects a little bit to secret sauce. The why us slide is what we sometimes call it. Also a little bit connected to the why now slide, which I haven't included here, but the why now slide is a good slide to kind of put FOMO into your investor's mind and say, hey, like this is a very hot market. If we don't get in on now, the opportunity is if you invest now. So it's that FOMO honestly, sometimes helps with getting better valuations or just putting pressure on your investors to move quicker with the transaction. Okay, so next up, final section, which is not even a section, it's more like a transactional part of it, is just the ask. What are your financial forecasts? You should normally do 3 or 5 years of financial forecasts, and we have the next few slides talk a little bit about that, so I'll get there. And the ask, which is just how much money are you raising, and where is that going to get you to? So, whenever you're struggling, remember the little section system. Try to compress each slide or try to put each slide in the section where it belongs. Sometimes the team slide goes at the beginning. I mean, you can break the rules, but it's kind of weird, right? It's like, okay, what are you even doing? If you have all this experience, why is that experience useful? I don't even know what you do. Like, why is your experience impacting this company that you're starting? So again, you can make exceptions to this rule, but I really, really like this structure. And I think that most of the decks, even though they don't use this framework explicitly, like you don't see it laid out, most of the decks that you'll see from successful companies, more or less follow a format like this. So, okay, let's move on. I see a bunch of questions in the Q&A coming up, and on the YouTube stream. I'm reading, but I want to get to questions at the very end. Okay, so some resources to help you guys out. Well, literally, this is what we do, right? We're a pitch deck builder platform. So most of our templates use that, but these 2 in particular are good examples of templates that kind of follow this approach to the line. The top one we built ourselves, like that's our standard pitch deck template, and the one below is the Airbnb deck, which is one of my favorite pitch decks out there. So a fantastic reference for you to look at. That's on the pitch deck side. We recently launched an AI builder because everything was doing AI now. But we're trying to save you some time on the process. And what we do is we crawl your website and we try to generate a slide from it. Sorry, slide deck, a pitch deck from it. Basically, like reverse engineering what your solution is to find the problem, to assume someone go to market. So it's a good start to kind of write a summary of what you do, but it obviously needs a human input. It's AI is not there yet to help to write pitch decks from scratch. We'd be our consulting team would be out of business if that were true. Okay, and then a couple ways we can help further beyond the templates, which are free to start with. We have a plan called Slidebean Accelerate, which is pretty much everything that we've built or all of the expertise that we have around pitch decks, we just put together into one plan. So it is a subscription. Every single Accelerate customer starts with a kickoff call with me. So it's a good chance to kind of get to know each other and see where you guys are and point you guys in the right direction. But then the biggest feature is not talking to me, but you have monthly calls, like monthly sessions with our pitch deck team and with our financials team to go over your pitch deck, get feedback, and go through a new round of iterations, right? So like we're literally kind of holding people's hands through the process of writing and refining the pitch. Okay, so let's talk a little bit about investor type. So one of the common problems that again we see with companies is they're just targeting the wrong investor type. So I made this little cheat sheet here, which we're also gonna paste in the chats. And I'm gonna zoom out in this for a sec just to make sure that we get on the same page about what your company stage is. Most of you guys, I would bet, are either idea stage companies, pre-seed companies, or seed companies. Now you don't need to type it out, but think of what stage you believe your company is in, what type of round you're racing. Are you racing a seed round or are you racing a pre-seed round? And then I'm going to give you kind of like what the requirements are for each stage, and we'll see if you were wrong or right about it. Now, I'm going to start with pre-seed because it's right in the middle. So what's a pre-seed company? A pre-seed company is normally a company that has, 2+ founders, at least 2, normally 3, maybe 4, that have the core skills to build and launch this product. So the funding team can build a prototype. They don't need any external people to build it. Like they have the skills to do it. They may hire extra hands to move faster, but they have the skills to do it. They have deep insights into the problem based on their own industry expertise. And they have a clear picture of how the product should work. They maybe started developing a low fidelity prototype. So they've started some work on this. They've definitely have had conversations with potential clients. They understand what their pain points are, how much they'd be willing to pay. There are strong indications that this is a big market. There's a big opportunity here, and they're essentially raising money to begin building. Big deal breakers that would make a company not be a pre-seed is if they're still missing a co-founder, then that doesn't make you a pre-seed company. That would mean you're still an idea stage company. Or if one of the skills needed to build a product, to get the product to market, is a skill that your team doesn't have yet. Right? That'd be another reason where a deal breaker, if you will, that would put you outside of the pre-seed stage. Now, the important thing about rounds of funding is that you normally raise funding to get from one round to the other. So if you're raising a pre-seed round, the idea is, well, this capital should last until you get to seed. So what's a seed round? Well, a seed round is a company that has launched a product that's growing. In SaaS, that'd be like 25. When we raised our seed round, we were probably doing, some $20,000 in monthly revenue, I would expect. It's a company that's growing. It's a company that's figured out some of their shit. They know how to get customers. Customers are happy. They've proven that they can launch the product and get it to market. And that's what makes up for a good, solid seed round. If you have launched a product but have no customers, you're not a seed company yet. You're probably stuck somewhere in the middle between pre-seed and seed. And that's why it's really important to understand what these stages are, because raising money between rounds is really hard. If you get stuck between one round and the other, your chances of raising money get slim. Like if you get stuck after seed and you haven't gotten to Series A, what are you? I mean, you'd be a post-seed company, but post-seed rounds are never good news. Post-seed rounds are never good news. Post-seed rounds is just someone saying, oh, like I raised the seed, I couldn't get to Series A, and I need a little extra money, so I have to raise it. And a lot of companies fail. Slidebean, we are a company that literally got stuck between seed and Series A. and we sort of had to do a balancing act to survive. We weren't able to raise a Series A round after that because we just couldn't get to the metrics. A Series A round, by the way, is probably $2 million in ARR. When we try to raise our Series A, we had about $1 million in ARR, and we just couldn't do it. And so yeah, and idea stage companies, going back to the top of the chart, idea stage companies can't usually raise a lot of money or money at all. You at least need to fulfill the requirements of pre-seed, which aren't complicated. They're not expensive. You just need to have that ready. Now, question to you guys: did I change your minds? Did I move you from one stage where you thought you were to another stage? I'm curious. Just drop a note in the chat if that happened. Okay. So some thought exercise around this. So, is your company ready to raise money? Like, are you ready to go to investors? And let me go through this again, this little thought exercise. So a standard venture capital pre-seed round, let's say it's something like $500,000. That's what the company needs to get off the ground. So the company wants to raise $500,000, and the usual suspect is that the company is planning to give these investors something like 15% of the company. Right? That's a usual, typical startup funding round. Okay. If you're giving 15% of the company to your investors for $500,000, then what you're basically saying is that your business is worth $3.3 million. That your post-seed valuation is $3.3 million. Or post-money valuation, sorry. And then that begs the question, well, is this idea thing that you have, this pre-seed company, is that worth $3.3 million? Is an idea worth $3.3 million? Normally, the way you would value a company is based on its revenue, but this is just an idea. So we're kind of valuing it based on the potential, right? So, okay, what's the potential? Well, you could say that your business, the reason investors get into these companies is because they believe that they can 10x their valuation, their investment in 10 years, right? So, okay, can you 10x your $3.3 million valuation in 10 years? Can you, or in 5 years in this case? So can your business be worth $33 million in 5 years? Okay, one way you'd be worth $33 million is if you have an EBITDA margin of 6 million, right? So normally EBITDA is your profit margin, your net income. You could value a business in 5 times their EBITDA, maybe. And then that would justify that valuation. Okay. Do you have a path? Does your business have a path to $6 million in profits per year? Not all companies do. Or is somebody gonna buy you? Somebody willing to pay $35 million to buy this company, this technology, this IP? Or is somebody buying your user base, right? So a good example I use is when Meta or Facebook acquired Instagram, they paid about $3 per active user. The $1 billion Instagram exit was literally something like $3 per active user. Or are you raising a Series B at a $35 million valuation in 5 years, and is that going to justify it? Or are you going to go public, and that's how this valuation is going to be realized? If you don't have an answer to this question yet, you may not be a pre-seed company yet, and that's why I kind of go through that thought exercise, because a lot of companies I talk to, they're trying to raise money, and they're trying to raise money on that 15% proportion, but they're not building a business that scales that big. They're maybe building a $10 million business, and if that's the case, then that's not, then the valuation doesn't make sense. Like, investors are never going to make their money back. So one commonly overlooked problem. So I'm happy to touch more on that if you have questions. So drop them in the Q&A. Okay, let's talk a bit about budgeting. So budgeting. Now that we've talked a little bit about rounds of funding, here's an extra trivia question to see if you guys have been paying attention. So if you're a seed company, right, how much money should you be raising? Should you be raising A, 18 months of runway, B, whatever amount of money it takes to reach the next funding round, or C, enough to launch the product? What do you guys think? I see a bunch of B's coming up on the webinar chat. The YouTube people are maybe a couple seconds delayed, but I see a bunch of B's. You guys have been paying attention. Most people will go for A's, but A is a trick answer. The answer is most definitely B. Sorry, there, Jesus, there, yeah. So the answer is most definitely B. Why? Because 18 months of runway doesn't guarantee that you will reach the next fundable milestone, and that's a factor. I see Malin from the YouTube stream got it right. It doesn't guarantee that you're going to get to the next fundable milestone. C is not the right answer, because if you're a seed company, you've already launched the product. You're post revenue, so it's not C. And then A, I'm sorry, and then B is, yeah, whatever it takes to reach the next funding round. Now that can't be unlimited capital, right? It can't be that much, like needs to be reasonable. And normally it should take you about 18 months of runway to reach the next fundable milestone. But you normally raise money to reach a milestone, not on a time basis. Okay, so how do you know how much money you need? And that's the question now. How do you know how much money you actually need? I got this question last week. A company asked, like, don't you just raise every month, every dollar that you'll spend? Well, no, because if you're a seed company, you're going to have revenue, and you need to assume that there will be some revenue, right? For, that's going to cover part of your costs. It's not just all expenses. So a common mistake founders make is something like this, where they'll say, oh, we're going to generate 700 orders when we launch, and then we're going to grow the number of orders by 10% every month. And if you were to map this in a spreadsheet, as a budget spreadsheet, it would look something like this, where you'd have 700 orders the first month, and then that growing by 110% or by 10% every month, right? And then just drag that formula all along the spreadsheet, and you're done. And if you do that, what you end up putting on your pitch deck is a chart that looks something like this. And that's a pretty nice looking hockey stick chart. But is that correct? Like, are you going to grow 10% month over month? Why? How do you know? This is literally just a 10%, 110% math operation you put in a spreadsheet. Like, can you stand by these numbers? Can you bet people's livelihoods, people's salaries, employees on your assumption for growth? Probably not, right? So how do you estimate? And by the way, this is usually a red flag, right? If you see a pitch deck and there's just a hockey stick chart there with no other it's not justified, it's usually a flag that somebody hasn't done their homework. So again, if we establish that we're raising money to get to a certain milestone, and we're going to have some revenue because we're a seed company, we have launched a product, and even a pre-seed company, right? So pre-seed company raises money to build a product, get to seed, so they will have some revenue at some point in their budget, right? It's not just a purely expenses company. So we're going to have some revenue, we're going to have some expenses. Probably expenses are going to be larger than revenue, and that's okay because we're starting up and we're investing and so on, R&D. But then, we want to reach this certain milestone. And then the question is, well, what's driving each one of these? What is going to drive your revenue? What's going to cost more revenue? It's not just 10% month over month. And at the same time, what's going to drive your expenses? How do we understand and reconcile these two things? So when I say, okay, let's start with the revenue side. When I say revenue, it's like, okay, what's driving my number of orders? It's not just 700 orders a month. And then orders may be traffic, orders may be subscriptions, maybe monthly active users, drivers, riders. Like, what's driving this? And on the other end, what do the other orders drive? Like, the more orders you have, do you need extra fulfillment costs? Or if you're a subscription, do you need extra hosting costs? If you're a service, do you need extra support staff? Like, what do these orders drive, right? You need to understand these things so that if you want to budget correctly, right? Because if you suddenly double your revenue, you have to account for, well, what's the cost of serving these customers that just paid me? Like, how much does my team need to grow? So this causality, this cause and effect is one big focus of what makes pitch deck solid, right? What makes your fundraising, your business pitch case solid? Just understanding the relationship between your expenses and your revenue. So if we have revenue at the very core, we can do here and say, COGS, cost of goods sold, right? So it's everything that you have to spend because you make more revenue. So everything that's connected directly to revenue, that's a cost. And you have to make sure that those are accounted for and that those are scaling accurately with revenue. But on the other hand, you have drivers, right? So what's driving revenue for you? What are you spending, or what are you doing? What is your company doing that's constantly generating more revenue every month? What is your driver? And we give a few examples of drivers that drive revenue, right? So revenue doesn't just happen. Customers don't just come. So what are potential drivers? One driver could be paid marketing, search ads, display ads, retargeting. One driver could be outbound sales teams. If you're a B2B platform or enterprise platform, you probably have a sales team that's doing business development, doing cold calls, cold emails. You might have organic traffic because you're pretty good at SEO. So that's that's driving the number of orders and so on. Or you might have returning customers, right? So customers may come to you again because they made a purchase and they made another purchase next month. Maybe it's some form of subscription. So if you understand these drivers and you understand how they play and how they connect into everything that you do, then you can create pretty accurate forecasts. Now, not all these drivers are created equal. Some of these drivers are a cost to you, and that's the other part of the budgeting side, right? It's not that, if you're going to do paid marketing, you have to pay for this marketing. It is an expense, and that's why we color coded those. Organic traffic is a little different. Organic traffic, obviously there's an SEO team behind organic traffic, or there's a social media team behind organic traffic, but you need to account, or you need to assume, okay, like, how is my organic traffic going to grow and how is it going to drive revenue? Because all of these could be drivers to revenue, and that's the point of this whole ordeal. Now, if you kind of put all those together and start adding some complexity to it, you can build something like this. And this is a model for an e-commerce platform where we have, think of it as a little bit of a flow chart, right? A paid marketing, paid traffic on one side, organic traffic on the other side, orders moving forward to, from your new customers, from your returning customers, to give you orders, to give you fulfillment costs down here, which are cost, to give you revenue up here, and then the cost of these products. Now, I don't want to stop too much on this because I want to get to your questions and I want to be useful, but we do another free webinar. We're doing another free webinar just on this next week. I think it's also on Wednesday, but we'll also paste the link in the chat if you guys want to tune in for that. Also free, also streamed on YouTube if you want to tune in. Okay. And yeah, the end goal of that is this. The end goal of that is a full-on, fully built financial model that can just generate the estimates that you need. And financial models are usually pretty ugly, and they're usually blue and black. We've tried to color code it a little bit, and I think it's been helping founders kind of understand it better. We also have a bootcamp, a financial modeling bootcamp, which we run once a month. We're currently on the August bootcamp. Sorry about this outdated date. And our team can also help you run this. But before you get into any of that, my suggestion is come to next week's webinar. We'll paste the link. Okay, almost done now, and getting into questions. Reaching out to investors. The biggest warning I'll give you on this is do not ever, ever, ever send cold emails. Cold emailing investors is a rookie move, and it doesn't work out, and you don't get investments because you cold email investors. I get the occasional email blast that I know was sent to hundreds of people with a pitch deck. Somebody's just share their pitch deck publicly. Sometimes it has even revenue metrics in it. Don't do that. Like, it's disrespectful to your potential investors. I've never heard of anyone that has been able to raise any money by cold emailing investors. The way to raise money from investors is by getting intros, literally by navigating your network and getting intros. So I'll give you a little cheat sheet here, which is a little intro email on how to do a proper warm intro request. If you wanna screenshot that. Normally what you would do when you're trying to get an intro is send a little blurb of what you do that can be forwarded to your potential investor by your mutual contact. But the work of raising money is a lot of just trying to find people, right? Just crawling through hundreds of investors in your area, in your industry, in your city, that invest in your space, that invest in your company stage, and just trying to find warm introductions to them. We have a little tool called an investor finder that can help you find investors, at least filter out some of them, so that you can save some time. But the work is probably on LinkedIn, just finding those second level degree connections and trying to create relationships with them. Okay. So that's pretty much the timeline of a pitch deck, going all the way from warm intro to pitch deck to first meeting, et cetera, et cetera, et cetera. Some people will accept it, some won't, but the ones that do will give you a term sheet, and then due diligence, and then money. Like, we've made a little video that goes over all this process. I think it's a great video. It's just so niche, right? It doesn't have, maybe it has like 10K views or something like that, but it's such a niche video, but it is a full overview of this process. So if you want to check that out, it's on the YouTube channel, on the Startup Club YouTube channel. Now, to wrap up, I think. Yep. Just a reminder, like, this is wrap up before I get to questions. Sorry. Just a reminder, this is what we do. We stand behind, we try to help untangle the work going from pitch deck to funding so that you can get to the actual tangle that it is to run a successful company. Again, some of the best resources I can give you on that our Accelerate plan, which includes reviews, our AI pitch deck builder, all of our templates, monthly reviews with our team, both on the financial side and the pitch deck, and a kickoff call with me. That's our Slidebean Accelerate plan. It's just $99 a month. But if you want our team to actually get involved in helping you write a pitch deck from scratch, we can do that too. Just email us at webinar@slidebean.com. And I think that is finally it. So I'll stop sharing and I will get to your questions. Okay. So yeah, just throw them in the chat. I see some questions lagging. I mean that I saw as we were going through the session. So I'll get to those first. Okay. So Alejandra, is it possible to download my presentations made in Slidebean? I just need a PDF. Yeah, you can do that. Sure. That's one of our first features. Not a problem. Can a startup based internationally seek funding from VCs in the US and relocate there to operate? I'd say you first, I think, need a foot in the US in order to raise money from. Let me take a step back. Normally, investors are willing to invest in companies that they understand. And we used to have this term like companies in their backyard. And the backyard is not so much about where the team is based. I think that investors are more open now to remote teams. I think it's much more about a market that they understand. You know, if you're a company that sells, I remember this case. I knew some friends that build like this obituary service for Egypt, and I met them in the US, like they were doing 500 startups. Why would a US investor invest in that? They don't understand the culture, they don't understand the sales process, they don't understand the market. And you can give them market stats, but it's not enough like to bet tens of thousands or hundreds of thousands of dollars in a company that's doing something outside of your area, right? So if you're the location of the investors that you target needs to be somewhat tied to the market that you're targeting and to the type of customers that you're targeting. We've done it. Like I'm Costa Rican. I moved over to the US to start these companies because my customers were primarily in the US, right? So and many of our investors are US investors. So that makes sense, right? So moving in is valid, but your product needs to be about that. It's not that you're building a product for an entirely different market and then you sort of go to the US because that's where the investors are. That story doesn't fit that well. Okay, Alejandra, would this help if I'm a nonprofit that is trying to be self-sustainable with its own business model? I'm not sure what your quest would what help, sorry, would the pitch deck help? The financial forecasting would definitely help, but I don't know if the pitch deck is a little different. I mean, I'm not sure if I understand the question. Yeah, so I mean, the pitch deck is normally what you would use to go to investors, right? Pitch them on what you plan to do if you want to raise money. It's a bit of a company summary. But if you're not pitching investors, if you're just trying to build a profitable business, then I mean, focus on that, I'd say. Okay, let me see if I can find another one. Oh, I see your question on international startups. Happy that you joined the Zoom link. And thanks, Thibault, for the note on the content. Glad that it's been useful. I see Chinmay. How do you define where you want to be at the next funding round? In terms of traction, it's pretty standardized. Everybody understands, or I mean, investors understand, hey, like a seed company or a seed round is a company with revenue, with growth, with some customer understanding, with traction. Investors understand that a Series A company is a company with 2 million-ish in annual run rate. That's growing, that understands their customers, that has low churn rates. Like those are pretty standardized. And I'm talking about SaaS because that's the market where I operate in and where I'm the most familiar. But there's an equivalent for that for e-commerce or for marketplaces or for other types of tech companies. So you want to make sure that when you raise money, it's enough to get to those milestones. Milan, I see you. Do investors invest in solopreneur startups in pre-seed AI tech product, MVP in progress? Right off the bat, I'd say it's very unlikely. Milan's question for everybody who's not on the YouTube stream: do investors invest in solopreneur startups in pre-seed AI tech products, MVP development in progress, need to recruit talent to complete the MVP? So I see two usual deal breakers, right? Solo founder, and need to recruit talent to complete the MVP. That's usually a case that wouldn't deal breakers that would make you an idea stage company rather than a pre-seed company. It sounds kind of a bit counterproductive, but your capacity to recruit someone else that believes in what you're doing and that's willing to quit their day job and come work not for you but with you on this, like just your capacity to create that connection is, I think, the first test that you're onto something, right? If nobody else wanted to join, or if you couldn't recruit anybody else, it's either because the idea is not that good, so nobody wanted to join, or because you don't have that big of a network, which would be a flag to investors too, because how are you going to recruit your team eventually? So that's it carries a lot more weight than it seems, just being a solo founder. Then so on Chimneys, what if it's a social network type product that can only be monetized at scale? Yeah, I mean, same, like if you're, there are standards for what a seed and a pre-seed round is, even if you don't have revenue, right? So if you're a social media platform, you can look at history, right? Like where was Facebook when they raised their pre-seed or their seed? Where was Clubhouse? I think is a really recent example. It's not doing that well, Clubhouse, but when they raised their money, what did they have? Did they have a product? Did they have users? What were their monthly active user numbers? Like you can use those references to just understand kind of like what those milestones are to raise the funding. If you're not making revenue at the get-go, like on a social media platform, that's okay. But there's a monthly active user metric that you should be aware of. Okay, and I'll take the last one from Andrew because I'm about to lose my voice. As someone in the idea stage, what is usually the appropriate amount to raise without being overwhelmed by investor pushing for faster for the product? Idea stage companies don't usually raise money, Andrew. That's kind of like the point I was trying to make. You need to be at least at pre-seed, and the money you raise must be enough to get to the next fundable milestone. That's the general rule. And then one last one from Ben. Why us slide? 3 founders work in the area for new business and see an opportunity, but lack experience in big business and only one in tech. Is there guidance on how to round this? Hmm. Hmm. I mean, you're trying to build the best case possible, right? Um, my case when building a presentation platform when we raised money for it was, well, this is my second company. I understand how startups work. We've I'm pretty good at marketing. We have some people who are pretty good at product, and they had some backgrounds. We had never built a presentation platform. We had never built a B2B SaaS platform. Neither of us. So that's it. I mean, those are flags, and there's nothing we can do about it. That's just what it is, right? So we have to use our other assets to sort of convince people that we can take this through. So that's kind of the point. Like, you may not have all. If you have every single thing covered, then you're a very fundable, very exciting company, and raising money will be easy. For everybody else, like we're probably missing something, so we sort of have to overcompensate that. If you lack experience, how do you compensate for that? Well, by proving that you guys could build it, by proving some traction, for example. Okay. And then Addy, now this is the last one. Addy will take it. What the startup I was going to build. I'm the international guy. Well, the startup I want to build is huge. Kind of a talent is required, plus the network that I need in the US, which the scale that I want to grow should be executable, a product where anyone can use it. Still vague, right? Like everybody's building, and no offense, Addy, but everybody's building a huge product that everybody can use. Like everybody wants that's very much the dream, everybody's dream. So that doesn't make you different. What makes you different is what I would try and ask. If you're an outsider to the US and you want to move to the US to start your company, investors are not going to fund that. And that's important. Investors expect you to have the network and the connections that are needed. And then they're just investing in this to put fuel to the fire. They don't want to go through the risk of funding someone that they don't necessarily believe they can execute, right? So execution, your capacity to execute is the biggest thing about the pitch deck. And if you take one lesson from today, aside from a little flowchart framework thing, is the pitch deck is essentially proving that you can execute on this, whatever the next step may be. All right, guys. Thanks for tuning in. A bunch of people tuned in today, so I'm pretty happy. Remember, our accelerated plan is probably the best way we can help you across the financials and the pitch decks, and even with some one-on-one time with me. Hope that this was all useful. Screenshot, save it. The recording is on the YouTube channel on the Startup Club channel, so it'll live there for a while. I'll catch you on the next one. Remember, there's another session next week, doubling down on financials, so don't miss that. Bye.